Hey, it's Amy Lewis from the KFBK Morning News with Brandon Haefele from Catalyst Mortgage. This is, of course, the Catalyst Report. And we're talking today about a major change in lending that has taken effect. So what exactly is it, Brandon?
Well, recently, Amy, credit scores have always been affected by judgments, tax liens, and so on. So recently, the credit bureaus have made a change that if you do not have, or if the correct information, spelling of your name, date of birth, and or social security number is not correctly reported, it will not show up on your credit report any longer.
So if I have a lien, there's a chance that it could not show up on my credit report just based on the spelling of my name or the fact that it's not complete?
Correct. It's based off of the... Well, this could be a good thing and also not a good thing.
Okay.
So as of right now, anything, if I say Amy Lewis and I'm the IRS, I could go ahead and have something posted to your credit report without additional information. So you could have a tax lien show up. Well, what ended up happening is several consumers were having incorrect things put on their credit report.
Yeah.
And what was that, of course, doing? Affecting how they qualify for a loan, their credit score, and so on. So recently, several attorney generals throughout the country, along with the Consumer Finance Protection Bureau, worked with the credit reporting agencies, TransUnion, Equifax, and Experian, to make the change to where they have to provide additional information to the bureaus before something is added. The flip to that is, what if you're providing something and maybe you spell your name A-M-I-E-E and they reported it as A-M-Y and still with the other information? Well, just because of that, it might not get posted, which means as a consumer, you might be happy, but as a lender and as investors that are doing mortgage loans, it could actually change what's your true qualification and are you really, or should you even qualify for a mortgage loan?
I always wanted to go with the French spelling of my name, but couldn't go there. So what does it mean then for a company like yours?
Well, it's going to be a long-term process for us to really look at risk. We're going to have to see over the next 12, 18, 24, 36 months with these kind of things, what changes on default rates potentially, or if people are going to be late or 30, 60 days late. Now, I will tell you, is lenders overall, there are several checks that we do when it comes to different sources to check for tax liens, judgments, and so on. But the idea of something getting through is concerning to the lending, to the lending community as a whole.
So if I did have a tax lien on and I wanted to get a refi or I wanted to get a home loan, so how do you take care of that tax lien right away to make sure that your credit rating is better than it was before? If
you have a tax lien, first off, you can always contact your lender if you're in the process of either doing a refinance to look at having that paid off within the loan.
Yeah.
And then you also want to have we'll have to get a payoff from the IRS, but you can of course pay that off. Another thing is for people that are looking to purchase a home, if you do have an IRS lien against you, you can actually have it set up on a payment plan. And as long as you're able to show consecutive payments, and also, of course, an agreement with the IRS, you can still purchase with that being set up on an appropriate, payment plan.
But seriously, a tax lien is something that you don't want to hide because it'll
Absolutely
eventually,
not.
and that could, kill the whole deal for you.
Absolutely.
If you're a homeowner or get a refi.
Can. Yeah, it really can. And another thing that's recently changed, Fannie Mae has changed the underwriting guideline, or it's coming up, where instead of a maximum debt-to-income ratio of 45%, you'll be able to go up to 50% debt-to-income ratio. And really what that's going to mean is if a consumer, right now is been capped at a, refinance, a purchase price, they now actually should contact their lender to see about increasing that even further.
But is that the smart way to go?
With what?
I mean, because if it's 50%, then are you kind of putting yourself at risk financially speaking,
Personally,
in the long run?
I'm always the type of person that, you want to be able to have enough disposable, income to save. Would I recommend ever going up to 50% max debt-to-income ratio? No, I would not. 100%, hands down, don't do it.
Even to hear that, it scares me.
But you also have to remember, certain tax brackets will then be able to write off mortgage interest that will free up more on a monthly basis. So I think it's kind of really,
6 to 1, half a dozen.
Well, and it's also specific to the client. I mean, certain situations it might make sense depending on their tax benefits from being able to write off mortgage interest, whereas on others it doesn't make sense at all. First-time home buyers, for instance, I would say no way.
Yeah.
You really want to go ahead, go into it, know what you're getting into, know your payment, make sure you have room to breathe.
And honesty is always the best
Absolutely.
policy.
Absolutely.
It's tried and true, that's for sure. That's a Catalyst report. Be sure to call Brandon Haefele at Catalyst Mortgage at 287-7777, easy number to remember, or go online to Facebook and check out Catalyst Mortgage there, or even go online to catalystmortgage.com.